Joining us now is Timothy Tully. He's the CEO of ZelCore Technologies and has decades of experience in different areas of the financial services industry. Timothy, thanks for joining us. Appreciate it.
Great. Glad to be with you.
So just by way of background, our listeners today likely have a very different set of knowledge and expertise when it comes to cryptocurrency. So to get things started, would you mind just explaining to us what it is that ZelCore does, and maybe if you can compare and contrast that to some of the big names out there, such as Coinbase, FTX, and Binance?
Yep. Let me start with Coinbase, FTX, and Binance.
Sure.
They are, we refer to them in the crypto world as centralized exchanges.
Okay.
So in my mind, they're analogous to Fidelity, Schwab, and Ameritrade. Very similar. They just have a crypto mask on them. So they're not really crypto companies. They just happen to be traditional brokerages that have a crypto interface, if you will. ZelCore is and they provide custody, just like those latter entities that I talked about.
So maybe
ZelCore,
I came into some Bitcoin decades ago when it wasn't a big thing, and I could use it to buy pizza, but not a whole lot else. And I need somewhere to hold those Bitcoin. I could go to one of those custody places, create a wallet, and they would hold that cryptocurrency on my behalf.
Exactly. So
Okay.
ZelCore is a self-custody or non-custodial platform. So we provide the users the tools and technologies to do those services themselves.
So can you make an analogy to the stock market here in terms of what that would be like? Because I don't know that actually exists when it comes to, or maybe it does when it comes to, say, if I own a stock or a bond.
No, it doesn't exist. It's new technology.
Right.
And so there is no analogy. I think the way I use it to explain it to people is, in the model that we're familiar with, like Fidelity with custody, you buy 100 shares of Apple, they have an IOU to you, and they keep a separate database that tracks your ownership.
Mm-hmm.
In the world that blockchain is, the technology that it is, crypto allows to have a one-to-one relationship between the asset and you, and that technology allows you to have that wallet so that you can keep the asset to yourself and decide what you want to do with it or where you want to sell it.
And that was sort of the promise of crypto and blockchain technology from the beginning, was that transparency and ability to track the transactions and say, this is mine and I can prove it if I'm not mistaken.
Yep.
So if you could break it down for us better than I can about what has occurred over the last week when it comes specifically to FTX, because that is the big news. And then maybe we, if we have time, maybe we can go into what's going on over the weekend at crypto.com and other places.
Okay. Yeah. So what happened at FTX was, FTX, as I said earlier, is like a traditional brokerage, and frankly, their genesis was a lot of derivative trading around cryptocurrencies. But they were they provided crypto purchase and sale and derivative trading for individuals. But they had a lot of very opaque components to their centralized exchange, and they also had another arm's length company called Alameda Research, which is a hedge fund, which invested in a lot of crypto companies directly as a VC or something like that. Now it's come to light that they were using customer funds to transact back and forth to take care of obligations that the sister company, Alameda Research, had. And in some cases, depending on who you talk to, it could be as much as $10 to $15 billion of customer funds that were used to shore up some of the shortcomings on that side of the house.
Timothy,
and then there was a run-on situation, and that's
right.
What really exacerbated the events of the last week.
Timothy, you are used to the financial services sector and the level of regulation and disclosure that occurs there. How significant was this with FTX? Right? How clear was it to customers what was happening with their deposits on this platform, or was it clear at all?
I don't think it was, and I think although many people like myself, and we say in our company, as many non-custodial platforms, not your keys, not your crypto. That's the biggest problem. But I think people trusted them like they trust a Fidelity or a Schwab or these common household names that have the similar kind of implied arrangement, but it's backed by regulations from whether it's the U.S. government or international governments as well.
So what does this all mean, I guess? Is this some sort of turning point for the industry as a whole? I mean, we have fairly large publicly traded U.S. companies in the likes of Coinbase. There are some questions now being raised of Crypto.com about some different problems, but I think the same questions are being asked. Is this some sort of turning point for the industry as a whole when it comes to either regulation or technology?
I think it is a turning point for the industry as a whole. It was, as you mentioned kind of a couple minutes ago, the original intent of the technology was to be transparent and, more importantly, trustless, right? So the
trustless meaning you didn't need trust.
Exactly. So whereas you relied on a counterparty to perform the transaction for you, we needed to move to a more trustless environment. And what happened was we ended up with a solution that was easy for everybody, which was the FTX and some of these other exchanges, but it wasn't the right, most transparent solution. So I think this will force us to get there the hard way and in the expensive way, right? But lessons are learned quick and fast in crypto.